This is question number 5 of homework 11 for chapter 11. So this is sort of a comprehensive capital budgeting problem. We know the tax rate, we know the cost of capital, and we also are provided with this window with all sorts of information related to the project. Project is will last for 5 years, um, and then we can actually open this in Excel. But then we need to be a little bit more careful because if you check the Excel file, you'll notice that it has most of the information, but not all. For example, if you go back to this window, you'll see that it also has the information about working capital requirements and also the depreciation method, which is not mentioned, which is not listed in this Excel sheet. So let me just put that information here. Net working capital will be immediately it's going to be 280,000 for year 0, and then it's going to be 20% of sales afterwards, and 0 for terminal year. So that's what this liquidated. All working capital will be liquidated at the termination of the project at year 5 means. So that's basically summarizing the net working capital information. And the depreciation method, it's the bonus depreciation method, which means all the depreciation happens in year 1. That's what this bonus depreciation here means. It's due to the new law, 2017 new tax law. So so that's basically the setup. Now, let me just put the year number 0, 1, and then we can just drag the cell to the other years. It's going to be 5-year project, so that's what this looks like. And then we know the initial investment should be the sum of these two numbers, cost of new plant and equipment and the shipping and installation costs. So just sum up these two numbers, add up these two numbers. That's my initial investment. Why do I need that? Because that can help me to determine the depreciation schedule. Right? Depreciation again, that's a bonus depreciation because all the depreciation happens in the first year. So the first year depreciation will be the initial investment. And for all other years, it's going to be 0. So that's basically the depreciation schedule. And then we need to calculate sales. And in order to calculate sales, we start from the sales units, right? Sales units basically is provided in this table, year units sold. So I just copied that, and then because this is in a column, but now the information here needs to be in the row. So when I paste this, I need to be careful by choosing the paste special and then transpose. And then you can see that this automatically transposes to the in the row format. So that's the sales units for each year. And now we can calculate sales in dollar, right? That's basically it's just the sales units multiplied by the price. And price is given here, $300 each for each year from year 1 to year 4. So it's okay to calculate year 1 sales like this, but what I want to do is to fix the sale value for the sales price per unit, because that price will be the same for years 1 from 4. So when I fixed the sale value, I can now drag the sale to the other years. So Excel will automatically calculate the sales in dollar for me. And for the final year, year 5, because its unit price has changed, so I can just use year 5's unit sale number of units for sales multiplied by its unit price, sales price per unit in year 5. So that will give me the sales in dollars for each year. And now with the variable cost, why do I calculate all this? Basically, I'm generating sort of because the reason I'm doing this, all this is going back to to how the cash flows are estimated, right? We start from the operating cash flow. So operating cash flow, and then the formula, if you look at the formula, is basically EBIT minus the taxes and plus the depreciation. So everything needs to be incremental format. That's why we have the change here. But since all the numbers given are actually specific to this project, so they are already in the incremental format. That's why I don't specifically mention the changes here, but we should understand this means the incremental numbers for each of these inputs here. And that's the reason why I focused on the sales and the cost and the depreciation, because then that can generate the EBIT. And also based on the EBIT, I can calculate the taxes, and then by adding back the depreciation, I can generate operating cash flow. And then how do I get the free cash flow? And that then we have to do 2 adjustments. One is to take care of the change in net working capital, and the other one is to take care of the change in capital spending. And both are easily calculated. So going back to the variable costs, so this is again based on the number of units sold for each time period and times the variable cost per unit. And this will be the same for each time, each year. So I will have to fix the sale value for the variable cost per unit, and then I can extend this to all other years. And so I can automatically get the total variable costs. And fixed costs are easier because they are the same for every time period. So just to fix that also and extend that to other years. And together with the depreciation, now I can calculate EBIT. So EBIT basically is the sales and minus the variable costs and minus the fixed costs and minus the depreciation. So you can notice that for the first year, this is negative. And the reason for that is because we have a very large depreciation expense for that year. And this is due to the bonus depreciation method we used. And you can also imagine that later on, when we calculate the operating cash flow, because operating cash flow, we need to add back the depreciation. So operating cash flow might be positive because we are adding back a very large number. So in this particular year, actually we'll see a negative earnings, but a positive cash flow. All right, so the taxes will be based on EBIT. Normally taxes are based on EBT, right? Because EBIT is earnings before interest and taxes. And after deducting interest from the EBIT, then we get to the EBT, which is the taxable income. And taxes will be based on the taxable income. But in capital budgeting, actually we don't consider the interest expense in estimating the cash flows. But that doesn't say the interest expense or debt doesn't impact the project value, but that impact is incorporated into the discount rate. So we don't consider that in the cash flow estimation, which means that taxes actually in this case will be based on EBIT. So we just use the EBIT and multiply by the tax rate. So tax rate will be going back to the setup, it's going to be 23%, right? 23%. And extend that to all other years. And for the tax here, you can see for the first year, because the EBIT is negative, so the taxes are also negative. So what does the negative tax here mean? You can find what it means by simply looking at the, I guess, the footnote somewhere, or yeah. So if any losses occur, they would be offset by profits in other areas of the company. So that doesn't mean, this negative tax here doesn't mean that the company is gonna, the government is gonna pay back the tax to the firm, it, or the firm is getting a tax refund. It doesn't mean that. But what this means is that the firm can use the loss from this particular project to shield the positive income from other parts of the firm's operations. In other words, the loss of this project for this in this particular year can be used to reduce the taxes from other parts of the operations. So that's where this negative tax comes from. So now with that, I can calculate the operating cash flow, which is the earnings before interest and the taxes, and then we add back the depreciation, and then we deduct the taxes. So as I said, because we are adding back a very large depreciation amount, so this actually results in a positive operating cash flow. And now I can extend this to all other years, and Excel will automatically calculate these numbers for me for the operating cash flow. And then going back to the setup, actually the question is asking what is the initial outlay. So since I'm already at the operating cash flow, so why don't I just finish the free cash flow calculation? So as I said, in order to get the free cash flow, I need to do two more adjustments. One is to take care of the incremental net working capital. The other one is to take care of the capital expenditure, right? Capital expenditure actually is already here. It's the initial investment. So the other remaining work to be done is to calculate the increase or the change in net working capital. So then the net working capital, going back to this pop-up window, that will be 280. Yeah, actually, I already summarized the information here. So it's $280,000 for year 0. And then it's going to be 20% of sales afterwards. So it's going to be sales in dollar and then times 20% for each year. Extend that for all these 4 years, except for the final year, because the final year is going to be 0, because all this net working capital will be liquidated in the final year. So the level will become 0. But what we care about is the change. So I still need to do the change. For the starting year or year 0, since there's no prior year, so the change is simply the level. But starting from year 1, the change will be calculated based on year 1's net working capital minus year 0's net working capital. And then we can extend the same calculation to all other years, and Excel will automatically calculate these changes for us. So now I have everything ready in order to calculate the free cash flow. So free cash flow will be operating cash flow for this particular year 0. Operating cash flow is empty, but still I need to put that sale value here because later on I want to drag the sale to the other years. Hence, Excel can automatically give me the right answer for each year for the free cash flow. And then the operating cash flow minus the change in net working capital, and then minus the initial investment or capital expenditure. So that's my free cash flow for all. I extend that for all these years. This is what the free cash flow looks like. So now I can copy the number back because the first part of the question is asking what is the initial outlay associated with this investment, with this project. So I'm just get rid of the negative sign, and this is the initial outlay, and check my answer. And then what is the annual free cash flow associated with this project in year 1? And then again, just copy the number back. Copy the number back, and check my answer. And year 2, continue to copy the number back. And year 3, and year 4, and finally year 5, terminal cash flow. In general, the project might also have the salvage value or after-tax salvage value, but in this case, it doesn't mention anything about that, so we don't have to consider that complication. And this is my final answer for the terminal cash flow. And part D, what is the project's NPV given a required rate of return of 13%? So now I have the free cash flow for each year. The rest of the job is to calculate the capital budgeting decision making criteria. I mean the NPV based on Mpv first. So Mpv, we can use the Mpv function in Excel. So equals Mpv, open it. The first argument is the discount rate. So the discount rate here is 13%. And starting from the second argument, you can see it's value 1, value 2, value 3. This refers to the future cash flows. It doesn't include the current initial cash outlay. So we just put this number, year 1's free cash flow first, and choose all the sale values and close this. But remember, this Mpv here, since the starting cash flow is year 1's cash flow, so the Mpv function actually is only calculating the present value of all future cash flows. It doesn't include the initial outlay. So after doing the Mpv calculation, we also need to add the initial outlay. Why do we add instead of subtracting? Because this initial outlay already incorporates negative sign in front of it. So that's my Mpv. And just for some reason, I think in some questions before this one, I choose the format to be in percentage format. So that's why this number becomes in a percentage format. So, but again, let's go back to the rounding requirement, round to the nearest dollar. So I need to follow that. Rather than keeping 2 decimal places, I should just keep 0 decimal place. And then just copy this number back. This is my Mpv. And yes, because Mpv is positive, so we should accept this project. And part E is PI. So PI is profitability index. So Mpv is the present value of all future cash flows minus initial cash outlay. And PI basically is, instead of doing the minus or doing the deduction, we're actually doing the division. So we use the present value of all future cash flows and divide that by the initial cash outlay. And because Mpv function in Excel actually calculates the expected value of all future cash flows. So I'm still using the Mpv function here in order to calculate the profitability index. So this is 13%. And I choose the cash flow starting from year 1 all the way to year 5. And then I divide that by the initial cash outlay. And because the initial cash outlay is in negative format, so I need to add a negative sign in front of it to convert that into a positive number. So this gives me 2 point, and going back to the rounding requirement, round to 3 decimal places. So I format the cell here, and then choose a rounding to 3 decimal places, and then copy this number back and check my answer. And final, because the decision-making criteria based on PI is that if the PI is greater than 1, then we accept the project. And that's the case here. So we should accept the project because PI is greater than 1. Final check. All right, so the final part of this question is on IRR. So for IRR, we can also use a function in Excel, which is just called IRR. and equals IRR, then open it. And now you see that we no longer need the discount rate because IRR itself is that particular discount rate which makes Mpv to be 0. Right? So all we need here is basically the cash flows. So for IRR calculation, actually the cash flows start from year zero's number. So we choose year zero's number and all the way to the last year. And then you can see the second argument here actually is the guess. That's the starting value which we ask Excel to use in the trial and error process in order to find the IRR, which makes Mpv to be 0. So if you don't choose this number, Excel will assume it starts from 10%. So you can do that in this case because we know for sure there's just one single IRR. So for any starting value, it will converge to that one single IRR. So this is what I found, but be careful. The reason why I see 54% here is because it might be because that I choose to keep 0 decimal place in percentage format. But you have to go back and check the rounding requirement, round to 2 decimal places. So I have to format the cell again to keep it 2 decimal places. And you can also confirm, as I suspected, that the reason why I saw that it's 54% is because I kept 0 decimal place. Now, if I change that to be 2 decimal places, and you can see it becomes 54.10%. So I'm gonna put that number back, 54.10%, and check my answer. And finally, the decision-making criteria based on IRR's rule is that if IRR is greater than the required rate of return, here is 13%, then we should accept the project. Because IRR, it means the expected rate of return by accepting the project. So if the expected rate of return is greater than the required rate of return, then we should proceed with this project. And the answer is A, yes, the project should be accepted because that its IRR is greater than the required rate of return, 30%. Final check. All right, so that's this question. That's what this for this question.